The India shining theme is back in media headlines and in investor conference tables. And this time there is some market backing for this theme. The Nifty has outperformed Wall Street indexes, for instance, this year by a comfortable 16 to 18%. The Indian rupee has outperformed than three experts who have been listening to global investors and companies for the past few days at the JPM Investors Summit. Joining me from the sidelines of that summit are Puri, Chairman, South and Southeast Asia, JPMorgan Jahangir Aziz, Head of Emerging Markets Economics and Commodities Research at JPMorgan, and Sajjid Chinoy, Chief India Economist at JPMorgan. Gentlemen, thank you very much for finding time for me in your busy schedule. Mr. Puri, let me actually address that question to you. Are you getting this strong pro-India feeling from investors and global companies at your summit?
Yes, no, I think there's very much a sense that this time we might finally be getting it right. I know there's always a sense that in the past, India has held out promise and under-delivered, and investors, of course, are naturally skeptical. But I am sensing a shift in the recognition that this could be our sweet spot. Part of this is just, of course, the stability of government and leadership and the commitment to economic reforms. Part of it is the shift in geopolitics and India's realignment with countries that could be now a source of both capital and technology. And we're beginning to see the benefits of that in EV. There are discussions around renewable energy, discussions around electronics, and the China Plus One strategy is obviously something which is ours to lose should we seize it. And alongside that, I think there's some recognition that we may have weathered the pandemic better than many other countries in the sense of having come out with a relatively strong fiscal and macro backdrop to this. So yes, I think there is a recognition that this is the time that India should be very much in the limelight. Okay. The last point actually which has come out, I think, is that from a talent point of view, Lata, India is going to provide 20% of global incrementally available talent. So if we can skill this, we could be a huge additive not just to India's growth, but to global growth.
Okay. But Mr. Puri, is this a change in mindset only, or a change that is on the anvil, or are global companies reaching out for their wallets or their checkbooks, as the case may be? Any evidence of...
No, I think this is happening. Yes, I think there's evidence of conversations around engaging with India. I think consistent with the Modi government, of course, many people are having to look at partnerships, joint ventures. So in the real economy and in terms of FDI, you are seeing a recognition that what we call the Atmanirbhar model is probably the favored model. However, people may have different views on that, but I have spoken to many global corporates who are acknowledging this and clearly understand this is the way to go. Okay. So yes, there's plenty of evidence that this is going to be a real event this time around.
Yeah, I mean, after all, Atmanirbhar is our version of friend-shoring, near-shoring, or investment in the home country itself. Jahangir, you look at a bunch of emerging markets. Is there any edge for India? How would you place Indian macros vis-a-vis other EMs and vis-a-vis other DMs as well? Because looks like we have inflation more than our target, but it's not as off target as it is in several DMs.
Sure. So, I mean, if you just look at the performance of emerging markets in the first half of this year, what is amazing is that, they were hit by three of the biggest shocks we've seen in a long, long time, right? So, we came into 2021 with already 2022 with already elevated commodity prices. Then the Ukraine war took commodity prices even higher. You had the massive pothole in China when Chinese growth in the first quarter completely crashed. And on top of that, you had the central banks, including the Fed, very tightening aggressively, and which led to a very strong dollar. Any one of these shocks could have taken down one or several emerging market countries. We've seen that in 2013. But if you look at emerging market countries, they showed a remarkable resilience. It wasn't that growth actually was much stronger than in 2021. But the fact that growth actually delivered, even at a subpar level, given the background of the shocks, suggests that there's a significant amount of resilience going through emerging markets. And the reason why that resilience was there was just like the developed markets, emerging markets true during the pandemic and in 2021, there was a significant amount of excess savings. Excess savings defined as savings minus investment by the private sector, and that was the basis of the resilience. Now, in the second half of the year, some of the resilience is going away because that excess savings is coming down. Some of the Latin American economies, some of the European economies now have to pay the price for the massive monetary tightening that took place 6 to 9 months back. And in the case of India, I think even though we are still talking about growth versus inflation trade-off, I think the part that is disturbing, and I agree with Leo about the medium term, but the part that is disturbing over the next 6 to 9 months is that in all of this talk about growth and pandemic, etc., we seem to have forgotten that twin deficits is back on the headline. I mean, if you look at center plus state, it's probably going to be around 11-12% of GDP. If you look at the current account deficit, it's running at 4%. We really should take a very close look at that, because the last time something like that happened was back in the first quarter of 2013. And at that point in time, how that story ended. So while the medium term looks bright, especially if India plays its cards right, as Leo pointed out on the China plus one policy, as you talked about in terms of French shoring, etc. In the very near term, I would say that, once again, twin deficits has become a problem that India first needs to get over before we can talk about what happens in 22-23.
But are we the outliers in that? The strengthening of the dollar is not creating current account deficit problems for others, or are we the worst?
There are only two countries right now among the top 15, 20 emerging market countries where the private sector saving investment in the end of 22 is going to be lower than in 2019. One is Turkey and the other is India. Even countries like Brazil, they're going to be around 4 percentage points of GDP higher. Indonesia about 6-7 percentage points of GDP higher. South Africa, same in that same category. China would be about 2 percentage points of GDP of higher private sector excess savings than it was in 2019. The two countries that are flashing amber, one of them is flashing red, which is Turkey, but one of them is flashing amber at this point in time is India.
Oh, well, that's very important to introduce a note of caution into this rah-rah story. Sajjid, the GDP numbers came in lower than street expectations, or even RBI expectations. 16.3 was where RBI stood at, and the Q1 GDP came in at 13.5. How would you estimate the growth story? Is there enough steam in the private final consumption expenditure to still bring in a 7% growth, or will it be a 6 handle? And what for next year if there are global recessionary clouds?
Lata, so the glass half full is what Jahangir mentioned, that you've seen the savings investment balance in India go into a deficit in a way that's reflecting the fact that the private sector is gradually recovering from the pandemic. And as we've previously discussed, I think it's incumbent then on the public sector to reduce its fiscal deficits. Of resilience, like Jahangir pointed out, but we need to be careful about what the drivers of those growth were. So last year, for example, we grew at 8.7%, and 3 percentage points of that came from exports, because you had a strong global rebound, right? That was almost 35% of growth. It will be unrealistic to expect in an environment where global growth is slowing, Europe is in recession, China is middling, for India to get those kind of export tailwinds. So we'll have to be realistic that the drivers of growth this time will be different. The fact is fiscal policy is consolidating, monetary policy is normalizing, the global economy is slowing. So even if we grow at 6.5% or 7%, that would be admirable in this much more difficult global environment. I think the key here is that the supply side problems on private investment seem to have alleviated, the twin balance sheet problem. Now it's a matter of utilization levels. And this is where I think, at least if sustained government capital expenditure continues for a couple of years, both center and state, there is a chance here that you can progressively crowd in private investment. But the fact is, given this very adverse global backdrop, we need to be realistic about how much we can grow for the next 12-18 months and double down on macroeconomic stability.
So the global growth story, that is the one that could create problems for India growth and not give us that export tailwind. I have to scratch that point further with the other experts as well. A quick break and we're going to concentrate on the global backdrop. Back in a minute.